Hi, everyone. My name is Dustin Miles, and a partner with Momentum Multifamily. Super excited today that we have Jonathan Nichols with us. We're actually both in the DFW area, but anyways, Jonathan, I'll let you kind of introduce yourself, and excited to have you here today.
Yeah, thanks for having me, Dustin. Yeah, my name's Jonathan Nichols. My wife and I, we have a syndication company called Apogee Capital. And our story is we started investing in real estate right after we got married about 7 years ago
Hmm.
as a hobby initially and bought a bunch of single family properties here in North Arlington, where we live, which is in the DFW Metroplex, and use those to do short term rental. And we had, I guess, so much fun or so much success or a little bit of both that we decided we wanted to be full time real estate investors. And so started asking people who were full time investors what they did as far as a business. And most of them answered, we buy large multifamily properties. And so that's kind of what, motivated us or prompted us to make the transition over to the multifamily world. So we started buying during COVID, so around 2020, have done a handful of deals, have about 500 units as general partners. And that's what we both do full time now.
Oh, cool. Okay, awesome. And so, in are the deals that you're investing in are they DFW? Are they in Southeast, or where are your deals at?
Yeah, great question. So we've had a lot of success investing in tertiary markets in
Hmm.
both Texas and Oklahoma. I'm originally from Oklahoma. It's where all my family lives. And so we have a few deals in Tulsa. We have a deal in College Station. We have not bought anything, but have also looked in Lubbock as an example. So a lot of just strong tertiary markets is where we've kind of found our bread and butter. We do look for deals here in DFW as well, but that's just where we've had the most success, I would say, finding good deals for syndication.
Got it. Okay. Well, cool. And kind of curious, your role in the deals, and then maybe what you like to do. I know, when I first started out, it was wore all the hats, and I've kind of done deals on my own, and then partnerships and things like that too. So a little bit of a different mix, but yeah, just kind of curious what your role, on the GP is, and then what role do you like to do?
Yeah, so we started out co-GPing on the first deal that we did with some partners up in Tulsa.
Oh, okay.
Was a fantastic deal, and so my role on that deal back in, like I said, COVID era was first I helped with some of the acquisition. My partners
Mm.
lived a very long ways away, and so I did a lot of the due diligence walks, all of the on-site stuff. Because even though it's kind of far from me, a lot closer for me than it was for them.
Right.
Also helped with the capital raise for the deal. We brought about a third of the money to close the deal in for the capital raise, and then of course signed on the loan as well, and kind of helped as the operations took off. So that was our first deal. To date, I would say we've of the like six deals we've done, we've co-GP'd about half of them,
Hmm.
and then about half of them we've been lead sponsors on. And so as you said, when we started out, it was kind of wearing all the hats at once. And my background is I had a 8-9 year career working as an aerospace engineer. So I worked for a local aerospace manufacturer here in Dallas Fort Worth area, and left that job in 2021. And so I was the first one between my wife and I to leave my job and start working multifamily full time. And so I was wearing all the hats. The way we break our company up, we have kind of three sort of divisions, if you will. We have acquisitions, capital raising, and then asset management. And so I was doing all three of those. What's morphed over time is my wife eventually left her job, and we kind of found our own swim lanes. Is I focused more on the acquisitions. It goes well with kind of my numbers and risk assessment abilities and stuff that I did back as an engineer. And then she focuses more on the asset management. So her background is working as a consultant and a project manager.
Hmm.
And so she does more of that avenue. And we kind of meet in the middle on the capital raise. And so that's worked out really well for us. But my favorite thing to do is looking at deals, finding deals, underwriting deals, and kind of trying to work something out. So that's what I enjoy doing. It's kind of a hunt.
That's cool. Yeah, I've talked to, talk to different people all the time, and so really cool to hear how you guys kind of have, hey, here's your role, and so it's cool to be able to bring your spouse into the fold. That's awesome.
Yeah.
Um, just kind of curious. I my always looking to, as you've, kind of been in the space for a little bit and all that, probably knows, I mean, there's, once, or if you're an LP and you go to a conference or you go to some different events, it's, if you're an LP, it doesn't take very long to where you meet a lot of different sponsors or capital raisers pretty quickly. So I know, like, we're always looking to, how do we set ourselves apart from other folks? And
Hmm.
so kind of curious to hear from you if you think that there's anything that kind of sets you apart. I know, and maybe you guys attract this too because of your engineering background. I used to work for a defense contractor in DFW too. And so I feel like I maybe attract some engineers because of that. But curious if there's anything that you guys do to kind of set yourselves apart.
That's a great question. And I get asked that a lot, especially even from investors who are very sophisticated
Hmm.
and invest with a lot of different deal sponsors. They'll ask like, "Hey, what's the difference between you and, XYZ other people?"
Yeah.
All of whom are, as far as I know, great sponsors who
Hmm.
do good deals, who, have high integrity and all that.
Yeah.
And I think a lot of it comes down to the investor's appetite. We don't all do the same projects.
Yep.
One thing we've already talked about is markets, right?
Mm.
So I've tended to do more deals in higher cash flow markets to date. I don't know that that's what we'll always do or do forever, but for some people that's a win, and for others that's not their choice of investment. And so that's one example, but we could name several more. So part of it just depends on the investor appetite. I think, as you've already mentioned, the engineering background has really lent itself to making good investing decisions. And so, I think that today, in our current economic environment or current investing environment, where we see a lot of distressed deals, a lot of deals not running as well, kind of my, I don't want to say claim to fame, but, marketing that I've been putting out is that during 2021, we only did deals with fixed rate debt.
Mm.
So like all our deals now are, doing distributions. We're not worried about refis. We're not worried about rate caps. And, we did about half the number of deals as some of my friends. And so that's probably the, downside to our approach. But just kind of that lower risk approach has been something that has, really resonated with a lot of investors today. So I think that would be another thing, would just be that risk assessment that comes from the engineering background. One thing that I think we're starting to push a little bit more now, as I mentioned, my wife does our asset management, and
Mm.
obviously I'm a little bit biased, but I think she does, an incredible job. I mentioned, her background is consulting, and she has a great balance between, really getting along with the property managers. We use all third party management companies and
Mm.
have different ones for each market. And so there's a lot of work there in developing and maintaining relationships with those managers. But she does a really phenomenal job with it. But at the same time, she's really able to push them to get the results that we're looking for.
Awesome. Yeah, no, that's great. Yeah, it's it's interesting. I don't know, when I first started out, it was felt like every deal you just put two-tone paint, put in some final flooring, and then you charge $150 more rent, in rent, and then every few months, or probably, well, not every few months, probably every 6 months or so, we'd probably bump rent another 50, $75. And
Yep.
so it, when you have that type of market, and then you have cap rates, compressing and coming down, at least when I first started out, like, it was, kind of, a little easier, honestly. But now it's,
Right.
you got to work. So
Yeah.
it's tough. And so the people, I think right now, there's probably some people being, weeded out for either, lack of operations, or maybe they, to your point earlier, they were, maybe a little too aggressive, when the going was good. So, um anyways, I know, I'm sure you guys talk to a lot of different LPs, and we do as well, and always get some interesting questions. Rain, just where'd you grow up, or why do we name our properties in Houston Henry, and different things, and then some get very personal very quickly.
Mm,
But one question I always thought was pretty interesting that I've gotten from LPs, and it tends to be, sometimes it's more the more experience, but sometimes it's newer. But they're like, "What should I be asking you?" And
mm.
so, kind of curious. I'm sure. Curious to hear your thoughts, and I have plenty of thoughts there. But what should when LPs are talking to you, what should they be asking you? As far as the deal's concerned, and all that.
Yeah, I've had that question from LPs. It maybe
Hmm.
worded differently, perhaps, but the same question several times before. It's really great when they ask you that question before you have a deal, right? When it's just kind
Yep.
of an initial meeting, you're getting to know them, and we do pretty much exclusively 506B deals, so you're establishing a relationship with them. It's really a great question that you can use to your benefit as a sponsor because you can set the stage for the deal. So like, already mentioned kind of the debt thing has been something that's gone well for us on our
Hmm.
deals. And so, sometimes I'll set the stage, for an investor of like, look at the risk associated with the type of debt product used and does the return profile on the deal match that, right? So, if you're doing all deals with agency debt, you're probably not going to get the same level of returns that you do if you're doing heavy value add projects, but it's going to come with a lower risk as well. So I like to ask investors to really think a lot about risk. Debt's obviously a big topic right now. I think beyond that, probably risk with market and location, property managers' experience with the sponsor and the location. Probably we do have a couple LP deals that are a little bit dicey right now. And usually when deals aren't doing well, what I've seen is it comes from, poor property management at the site combined with an asset manager who either maybe they've taken their eyes off the ball or they just don't know how to work with that property manager to
Hmm.
execute the business plan or maybe even just do the day-to-day operations. And so I encourage LPs to ask a lot of questions around risk. What are the risks? Where are they at? And then them being able to think through if that's something that they're willing to accept or not.
Yep. No, that's great. Yeah, I like that. To your point about bridge or fixed, and and all that. And they do have different risk profiles and things like that. But I always tell people there's no free lunch. So I mean,
Mhm.
just because something sounds good and all that, there's like you said, there's risk associated with it. But on the flip end, I had, whenever I started, everybody did 10-year Fannie Mae fixed loans.
Yeah.
That's what you did. Not very many people, at least in my circles, did, you know, people didn't really do bridge loans.
Yeah.
It was 10-year. But so the flip side was, as interest rates kind of went down and all that, then we got, bit by yield maintenance and defeasance and things like that that were, hefty.
Yep.
Fortunately, mine weren't millions of dollars, but they were very, significant, portion of the loan. I mean, it's probably, 20-25% of the loan in yield maintenance costs. So, anyways, there's, everything.
There's always pros and cons. Yeah. And I
Yep.
think educating investors, because a lot of newer investors, they don't even understand defeasance or yield maintenance,
Yep.
right? A lot of new sponsors don't understand yield maintenance. So,
Yeah. Yeah, for
being
sure.
able to explain that where they know, how does that affect them or what is the risk? The risk is like, we may not be able to sell the deal at the optimum time.
Yep.
because we may have to hold longer to build an exit, without a hefty prepayment penalty.
Yep. Yep. I know something as we kind of got into those, I started doing, step downs and things like
Yeah.
that. So I'm like, okay, learned a lesson over here.
Yeah.
so, or you can do the partial and then a step down. There's a lot of ways to dice it up. But there's no free lunch because then your interest rate goes up a little bit
Be
too.
higher,
So
especially right now.
yeah. Yeah, no kidding. Well, kind of curious, what you guys look for in a deal. Just, I'm sure there's location, some other things that kind of play a part, but kind of curious to hear what y'all's deal box looks like.
Yeah, that's a good question. So I think that it's changed a little bit since we started, as we've kind of found our kind of what our appetite is. We've tended to gravitate more towards, I would say, like B class or C plus type of assets, particularly when it comes to location. You can't
Hmm.
change the location of the deal. We have one asset that is in a C location, not C minus, but a C location, and it takes a lot of work.
Hmm.
We have our newest asset's a 2012 build deal. That's the one in College Station. And it takes almost no work compared to, that other one. And so
Yeah.
we've seen the difference as sponsors in the level of work. And I know a lot of times for investors, it's like, well, I don't really care if it's 2012 or 72. It just really comes down to the returns,
Yeah.
right? But, if you can offer similar returns, with a newer asset or just an asset in a better location, I think that helps a lot. So location's really important. We like B and A locations, and then I would say C plus or better assets has been pretty much what we bought. Really like 100 units or bigger. That way we can have full time management on the property. That's been a pretty big one for us, I would say. Beyond that, I think just having a good property manager lined up. We've got one where we have several. We've got really great property managers, and we have one where they do okay as long as we stay really on top of them, and
Hmm.
it's a lot more work for us. And
Yep.
so it's really thinking about like where there's two of us, so like where is our time and energy best used on these projects,
Yep.
and that's kind of what I think we found our sweet spot to be: good locations, reasonably good properties that obviously have some value add component to them, which means there's going to be work and there's going to be risk, but and then good property managers to partner with.
Yeah, yeah, absolutely. It's crazy how much a property manager can affect the property performance. So, yeah, we've seen the deals that we've seen that don't necessarily perform well. It's come down to we've had the ones I've seen have had we bought a deal. Um, Late last year, and I think they had went through 5 different managers in the office within about 18 months or
Mm,
so, and you won't succeed, every single time when
yeah.
you have that turnover and then all that. So, um, well, cool. Just kind of curious if there's any aspects of multifamily that that you guys really enjoy. Um, I know that you guys moved away from your job, so obviously
Yeah.
you're in this, and there's in this what you do probably quite a bit of your time. So, anyways, just kind of curious if there's anything that you guys really enjoy about multifamily, or kind of maybe different from what you guys did as W-2, or maybe it's the same. So,
It's a good question. I mean, I think the business as a whole, we really enjoy because I think it bodes well with our professional skill sets,
mm,
that I've already talked about. I think that that was one reason beyond the economies of scale that we decided to go from the single family world to multifamily, because this business is more about running a business than it is, being in the day to day and what kind of lease do I use and how do I screen a tenant? That stuff is, generally you overlook it, but generally, done by your property manager. And so that's something that's worked out well for us. That's high level why we like the business. Within the business itself, I've already mentioned I enjoy the acquisitions. I enjoy
mm,
the numbers piece of it. One thing that I had no experience on as an engineer that I've really had to learn, and I would say come to enjoy over time, is the capital raise portion of it. So, I mean, as you probably know, in engineering, there's no sales classes, there's no marketing classes, like, there's barely any socialization. So,
Yeah.
that was a huge change coming into this business where everything depends on your network, both on the active side and in relation to your investors. But I've really come to enjoy the capital raise side. I think that we, meaning those of us in this industry, have a very unique product to offer investors that is, quite frankly, not known. Not a lot of people are not familiar with it. And so the opportunity to present that to them and give them other investment options outside of their 401k, outside of their traditional stock market investments that can truly benefit them and help grow their wealth. Learning how to communicate that to them and help them through that has been something that I've grown a lot in and really come to enjoy over time as well.
Yeah, that's awesome. Yeah, I remember when I first started, did my first deal and first capital raised and all that. It was so nerve-wracking. I was like, I'm completely out of my comfort zone 100%. So, and then the deals that was the first deal I bought, it's actually about almost 10 years ago now, but so the deal I bought, we had to do, we don't really do that now, but we had to do proof of funds and things like that. And
Mm.
it was, I had a little bit of money, but like not,
Not $2
not
million dollars to go close the deal. Yeah.
yeah, yeah, not a whole lot, and so,
Yeah.
I remember going to it felt super weird to ask for, "Hey, can you help me with the proof of funds?" And,
Wow. Yeah.
and that was kind of it was a little awkward and a little odd, and, like people, "Hey, yeah, sure, here's my bank statement." That's kind of not, at least within the US society, not the norm. People don't normally just,
No.
"Hey, here's my bank statement with all my money." Yeah, so that was odd, for sure. Well, kind of curious. Did you kind of come through? I went through two different mentoring programs and all that. Kind of curious if you came up in a mentoring program or if you guys just kind of networked and figured it out, or maybe some of the co-GP stuff kind of helped you guys get going as well. Just kind of curious what your journey looked like starting out.
Yeah. So when we started the single family world, it was the whole books and podcasts and bigger pockets episodes and all that kind of stuff that got us down the road. And so when we first started looking at multifamily, I thought, well, we'll figure this out just like we did the single family
Mm,
world. And so, we definitely spent our time, reading the books, listening to podcasts, learning the basics of deal analysis. But we could not even come close to getting something under contract or figuring it out. And this was
yeah.
before I even understood partnership and all that, which,
Right.
we've partnered on virtually every deal that we've done. So that's a whole nother conversation. But yeah, so we realized we needed some kind of mentoring. And so we wound up going through Michael Blanc's coaching program.
Okay.
I don't know how well, you know him or
Mhm.
familiar with him, but we went through his program, had a mostly positive experience. We're able to get our first deal completed, and then second and third, and now we actually are both coaches in his program. And so
Oh,
we
cool.
spend a little bit of our time kind of giving back through that and working with students that are trying to do their first deal and just kind of learn the basics of the industry. So that's something that I started doing that about a year and a half ago now, and Paula maybe 6 or 8 months ago. And,
Hmm.
we've really enjoyed, and it allows us to still kind of be a part of that ecosystem and network there too.
Oh, cool. That's cool. I
Yeah.
didn't know. I didn't know. I thought you were associated, but I couldn't remember
Yeah.
where. And then I didn't realize you guys are coaches. So good for you guys. That's awesome.
Yeah. It's a lot of fun.
Well, good. Yeah, I've been to his. I don't know if I'm gonna be able to go to the one in Atlanta, but I've been to his event a few times. And then I was hanging out with, drawing a blank on his last name, just hanging out with his business partner, kind of on the deal side, Garrett.
Either Garrett or Drew Niffin, one of those two.
Yeah, I was hanging out with Garrett
Yeah.
at a conference a few weeks ago. So
Garrett's a great guy for sure.
yeah, yeah, I got some interesting stories. So, but well, kind of curious. Do you have any? favorite books or podcasts that you want to share, and then also, I don't know how I'm a reader, but I wouldn't say like I'm not doing 50 books a year.
Hmm.
And, but kinda curious if there's a book that you've read more than once, because at least for me, if I've read a book more than once, then, like, I really enjoyed it. So,
Yeah.
yeah, kinda curious if there's any books or podcasts that you'd like
Is it
to
strictly
share.
related to multifamily or?
Nope. Whatever you want, whatever works for you.
Yeah.
Could be Harry
I
Potter, so.
Harry Potter it is. No. We I would say when it does come to multifamily, we've read probably all the kind of mainstream books.
Mhm.
I forget the name of his book, but Dave Lindahl's book was one of the first ones I ever read about multifamily, and
Yep.
it kind of had the effect in multifamily that I think Rich Dad Poor Dad did for me when I first started.
Mhm.
I don't think I necessarily learned all the techniques and stuff in it, but it was just that motivation of like, this is the potential of this industry. So
Right.
that's one that sticks out in my mind. Can't remember if I've read it more than once. More recently, and slightly less related to real estate, last year I reread a couple of times Ed Milet's book. I listened to his podcast a lot.
Mm.
The Power of One More. I thought that was just a phenomenal book for any type of entrepreneur. And then this year, a book that I'm focusing on that I've read through once already and plan to reread and kind of study through. I mentioned that I'm, become really passionate about the capital raise side of things and really worked hard at that.
Mhm.
And so there's a book called Pitch Anything by a guy named Oren Klaff, I think is his last
Oh,
name.
yeah, yeah.
Don't know if you've had the opportunity to read that, but highly recommend that book. It's
Okay.
basically he worked in an industry, a private equity industry that would be very similar to what we do, in
Mhm.
terms of requirements, talking to investors and such, and just some of the techniques and stuff that he talked about. They were, I guess, mind blowing would be the way to say it. They were just really hit me as like, wow, this is interesting. So that's a book that I've really enjoyed jumping into and still trying to get all the nuggets out of it.
Oh, cool. Okay. Yeah. No, appreciate that. Yeah, I've heard that book title before, and I've heard his name, but I've never, yeah, didn't really, hadn't really heard if, any feedback on the book. So,
On a,
um,
on a condensed level, he's done a few different podcasts, I think, with maybe Hunter Thompson
okay.
and Bigger Pockets. And so, you could catch him on an hour podcast to just kind of see if he's a good fit or not. But
Okay.
yeah, I've learned a lot from him.
Oh, cool. Okay. Well, kind of curious, where, you guys been in the space for a few years, and your coaches and all that. So what's in store? What do you see the future next few years, maybe just this year or the next few years? What does that look like for you guys?
Yeah, I think it's this balance between obviously we want to, continue to scale our business, compared to, someone like yourself or a lot of people, we're newer to the industry, having done it 4 or 5 years. I think we've had a reasonable amount of success in that time, but we'd like to continue to scale and, build up our portfolio, help more investors along the way. But it's balancing that between doing the right deals, particularly in, this economy where investors are a little more skittish. You do have higher interest rates. So it's just finding the right deals. Like I said, historically, we've done a lot of deals in tertiary markets and we've continued to look there. But I think really developing a presence here in Dallas, Fort Worth is kind of another big goal of ours over the next year. And so that's kind of where the horizon is, do a few deals this year, hopefully, maybe one or two here in Dallas and then, one or two in some of the tertiary markets that we're familiar with. And keep partnering with good investors that want to participate with us.
Awesome. And are you guys, I guess, to kind of follow on, so are you guys focused more on you're kind of the main sponsors and asset managers and all that, or are you guys also still looking at the co-GP model that you've done to start, or what does that look like?
We've done a bit of both, and probably
Okay.
will continue to do so going forward. I think in a perfect world, we'd be lead sponsors on every deal that we did.
Mhm.
Last year, and I always tell this to investors, last year we did one deal the whole
Mm.
year. That's it. It
Yep.
was a great deal, but we only did one deal. And so, we have a lot of investors who they would like to see more deal flow. They'd like to have more investment opportunities. And ideally, we don't just, send them to another sponsor, but being able to partner with other people and, probably get to that 3 or 4 deal a year benchmark would be, where I think the co-GP route is useful.
Mm.
It's just finding the right people and the right deals that, kind of align with what we're interested in.
Yep. Yep, for sure. Kind of curious if there's, we have a lot of LPs, limited partners that are like, hey, I want to be a GP. And,
Mm.
I think some of it is, maybe sounds cool, I guess. But, kind of curious if you have any advice for folks, wanting to be a GP, or, just advice on, maybe a path to take.
Yeah, I think one is just them understanding what's involved with being a GP. We've talked about some of the challenges and difficulties in this business, and I would almost argue that there's two different paths as an active partner on real estate. There's the deal sponsorship and the operator kind of side of things, and then there's more the capital raiser side. And
Yep.
obviously, for those listeners that are familiar with SEC rules and stuff, as a capital raiser, you have to have other duties on deals and stuff, but those tend to be pretty minor compared to finding the deal and being responsible for the business plan being executed. And so there's a, in my mind, lower level of responsibility and work required on that end once you bring investors in, is compared to being an active deal operator where you're visiting with the property manager sometimes on a daily basis to make
Yep.
sure that things are going well. And so I would tell new investors, think not just about, do I want to be active, but like, what does my route look like? Am I more in line with, hey, I want to find deals, I want to put them under contract, I want to put my risk money on the line, I want to operate the deal? Or are they more like, hey, I want to get an involvement, but not necessarily like a full time business? Because, you can speak for yourself on this, but I think Paul and I would both say that like we work more now than we did in our W 2 jobs by a long shot.
Yeah.
And we really love it and enjoy it, but that's not for everyone. And so I think it's just being really clear on what your goals are. And then beyond that, if once you decide what they are, I would really encourage people to get, some type of education for whatever they're doing. So
Mhm.
if you want to be an active deal sponsor, um, I think you and Hayden do coaching and stuff like that. I know that, Michael Blanc, Sunrock, there's a ton of different options,
Yep.
but figure some kind of educational avenue to where you can learn what you need to. If it's on the capital raising side, there's also a lot of programs for that as well.
Yep.
But
Yep.
don't just try to do everything by trial and error, because in this business, the big difference between multifamily and single family is you're using other people's money, and so I think that being educated up front is important,
Yep.
just to do right by your investors.
Yeah, absolutely. Yeah, and, did wanna clarify, we don't have a coaching program, but,
Okay, I don't know
uh
why I thought that, but yeah,
yeah, yeah. We just, I don't know, we, wanna just kinda stay in our swim lane, so,
yeah,
but,
absolutely. Yeah, not sure why I thought that, but I'm sure you could also reference listeners to several different options
yeah,
they
yeah,
could go explore.
I think there's, when I started out, there really was one, and that's it.
Mm, yeah,
And so now there's a lot of options, and then,
yeah,
obviously, YouTube's got more and more popular, and there's a lot of podcasts. So yeah, there's a lot of opportunities to learn and grow. And the other thing is too, when I started out, like, I didn't know any other really multifamily,
mm,
people. It just wasn't nearly as prevalent as is now. And so, now I feel like, especially, if we're both in DFW, it's, it's not quite throw a rock and hit a multifamily investor, but there's a lot of multifamily investors here. Phoenix is
sure
another
feels
hot
that way
spot.
when you're in the space, right?
It
It's kind of
does.
the
Well,
kind of the
it
red car thing, right? You
yeah,
buy a red car and that's all you see, but
yep,
I think that
yep,
there
yep.
really is.
Yeah, for
So.
sure. Yeah. So, well, cool. How can people get a hold of you? Do if you want to share your website, email, whatever is best for you. So, love people to be able to follow up with you.
Yeah, so our website is a great place to learn more about us. It's Apogee, which is APOGEE, MFC, like multifamilycapital.com. So we have a ton of resources and stuff. Also, I'm extremely active on LinkedIn. And so if you want to reach out to me directly, that's another good place to find me.
Awesome. Well, really appreciate you having you on today, and I'm sure I'll see you in person, see you on LinkedIn.
Yeah.
So, yeah, appreciate it, and have a great day. Thank you.
Thanks,
See
Dustin.
ya.
Appreciate it.
Bye.